In this video, I'm going to show you one single concept that most retail traders completely ignore. And that mistake alone is the reason why almost 90% of traders never become profitable. This is not a strategy, not an indicator, and not some magic entry model. Let me ask you a serious question. Why is it that you take trade after trade, your strategy looks perfect, your entries feel clean, yet somehow you still end up losing? Is it bad psychology? Bad risk management? Bad luck? Or are you simply trading blind? Because here's the uncomfortable truth most traders don't want to hear. You are trading lower time frames without understanding the higher ones. And that single mistake is silently destroying your trading career. Think about it. You open the 15-minute chart. You see a clean setup. Everything aligns. You enter. And within minutes, price violently reverses. Stop loss hit. Confidence shaken. Another loss added to the journal. Now pause for a second. What if I told you that the market didn't reverse randomly? What if it moved exactly as planned, just not from your perspective? Because if you want to know where market is going, then it can only be known by using higher time frames. And most traders never look there. This is where everything changes. Stay with me, because by the end of this video, you'll understand why higher time frames can change your entire game and how professionals use them to stay consistently on the right side of the market. Let's reset your thinking. Markets don't move randomly. They move with intention. And that intention is not created on the 5-minute or 15-minute chart. Here's the reality most traders are not aware of. Large orders are executed in higher time frames. So if you use that, you are with the ones who are controlling it. Banks, institutions, smart money. They don't care about your scalp setup. They operate on daily, 4-hour, and 1-hour structures. So if you're only trading the 15-minute chart, you're reacting to noise, while professionals are executing from structure. Now let me ask you this. Would you rather fight the market or trade with the people moving it? Exactly. This is why higher time frames are the easiest way to define bias. Let's break it down. The daily chart answers one question only. Where is the market trying to go? Up, down, or consolidating? That's it. No entries, no overthinking. Because you can easily define your daily bias with the higher time frames, if the daily is bullish, why are you aggressively selling on lower time frames? That's not strategy, that's gambling. And here's the cliffhanger most traders miss. If your daily bias is wrong, every lower time frame trade is already compromised. But we're just getting started. Now once your daily bias is clear, we move to the 4-hour chart. This is where structure lives. Higher highs, higher lows, breaks of structure, key zones. The 4-hour chart shows you where institutions are active, not where retail traders panic. And remember this, higher time frames are the easiest way to define bias. If the daily and 4-hour agree, you are now aligned with market direction and structure. This is where excitement kicks in, because suddenly, you're no longer guessing, you're following logic. But wait, what happens if you skip this step? Simple. You enter on the 15-minute chart against a 4-hour supply zone, and then wonder why price collapses. You weren't unlucky, you were uninformed. And this is why I say, you are not aware of what higher time frames can do. It's a lot beyond what you think. Let's go deeper. Now the 1-hour chart is the bridge. It connects big picture bias to execution precision. Here's what smart traders do. Daily to direction, 4-hour to structure, 1-hour to confirmation. This is where you wait. Wait for alignment, wait for pullbacks, wait for confirmation. And this is where patience separates professionals from gamblers. Quick question. How many of your losing trades came from impatience? Exactly. The 1-hour chart forces discipline. And once this aligns with the higher time frames, now And only now do we drop to the 15-minute chart. This is where most traders start. And that's the problem. The 15-minute chart is not for bias. It's not for prediction. It's for execution. When your higher time frames are aligned, the 15-minute chart becomes clean, simple, and powerful. Your entries make sense. Your stop losses are logical. Your confidence increases. And suddenly, trading feels calm. No more revenge trading. No more overtrading. No more emotional chaos. Because now you know something most traders don't. If you want to know where the market is going, then it can only be known by using higher time frames. This is the difference between traders who survive and traders who quit. And here's the biggest cliffhanger of all. Most traders never fail because of strategy. They fail because they never change their perspective. And that's why I'll say this again. Higher time frames can change your entire game. Not tomorrow, not next year, but starting this week. So here's my challenge to you. Just use it in your trading setup for a single week and see the results. 1 week. Daily bias, 4-hour structure, 1-hour confirmation, 15-minute execution. That's it. No new indicators, no complicated systems, just alignment. Because once you truly understand higher time frames, you'll realize the market was never against you. You were just looking at it from the wrong angle. And trust me, once this clicks, there's no going back. If you want more content like this, where we teach markets in an easy and simple way, breaking down exactly the way professionals see it, make sure you stay connected with the Insider FX. Because the difference between struggling traders and profitable traders is not effort, it's perspective.